I'm Marion Calcine. I'm Chief Investment Officer at Ardian Infrastructure. At Ardian Infrastructure, we manage $17 billion of assets, and we invest in Europe and in the Americas in telecom, transportation, and energy assets. The decarbonization landscape has grown more competitive and more complex. When we think about investing opportunities around the energy transition, we don't only think about the end game of renewable assets. We also think about interim assets that will move us along the clean energy pathway. Our recent experience shows two examples of this. We invested in Nevel, a district heating company in Finland, which was producing heat from peat. We have a transforming plan for the company, which will fully change its supply from peat to biomass in the next 2 years. And second, for us, gas is an important part of the equation and very much part of how the world will decarbonize. Renewable energy is not 100% reliable at this point in time due to intermittency, and gas will still play a key role in providing flexibility. In the US, we finished building CCGT, which will enable a market like PJM to exit coal. And in Europe, our coming partnership with A2A, a leading Italian utility, will accelerate the transition of their generation from mainly hydro and gas to predominantly renewable production. So this really highlights, I would say, how we approach decarbonization strategies in a world which is not yet 100% renewable. Renewable assets provide the path forward to decarbonize the world we live in. The renewable energy industry is undoubtedly at an inflection point today. While the energy transition is underway, with subsidy credits expiring across many markets, providers of renewable energy and holders of renewable assets are facing fundamental shifts in the way they manage their operations and investments. The market is becoming increasingly competitive, with utilities and oil and gas companies looking to increase their renewable capacity, while pension funds and insurance companies still want to increase as well their exposure to such assets. In a non-subsidized world, models for operational monitoring and merchant risk management need to be nimble and efficient. They must rival those of traditional utilities, which have long-standing trading experience and knowledge. Our thinking is that the most successful renewable players of tomorrow are the ones which will be equipped with the most innovative digital strategies today to set themselves from the pack. Investors and operators need to be prepared to operate in a world predominantly renewable and predominantly merchant, where volatility and competition between assets will be very high. So the goals of today are twofold. First, optimize production to extract as many megawatt hours of clean power as possible. This is what we want to achieve, having equipped all our wind farms and solar plants in our portfolio with Green Byte, a second level SCADA, giving us real-time monitoring of our more than 3.5 gigawatt portfolio worldwide. Second, we want to actively manage and hedge revenue exposure in order to stay on top of the market dynamics and capture the best windows of opportunities. This is what we want to achieve with PexaPark, a price discovery tool for merchant power markets, and also risk monitoring instrument, which enables to calculate the value at risk of our portfolio. Systems are crucial not only to remain competitive, but also over the longer term to develop arbitrage strategies, to predict power prices and assess whether it makes more sense to inject electricity into the grid or to store it in a battery. This will help to solve a key issue of renewables, which is intermittency. There are many, many benefits to having digital operating and risk management tools, real-time monitoring, as I was saying, enhanced analytics, which can provide valuable insights into operations, quantify also the risk exposure of renewable assets and portfolios, in absolute and in relative terms, enable more efficient and better informed decision-making in the hedging strategies that we put in place. And finally, more generally, guide portfolio construction strategies through the comparison of risk profiles of new investments. And I would say in a more ambitious way, stabilize a framework and methodology that can be replicated for other sectors across the infrastructure space.